we may have a 250 line due diligence sheet that we go through. We do background checks. We do hours of conversations with the sponsor. We dig into their life to find out what is going on with their business, what's going on with the market, what's going on with the particular deal. We dig into the PPM, read all the legal stuff, go into the loan documents. I don't know of too many investors that are going to really do that.
Hi, Adam Gower here, founder of GowerCrowd.com and host of this brand new podcast series, The Allocator, a new way of financing real estate. Well, my guest today is Jeff Greenberg, who is Chief Executive Officer of Synergetic Investment Group. Now, Jeff is an allocator, capital allocator, but his background covers also actual hands-on experience managing properties himself. And prior to that, he was in the IT industry. So he has very interesting insights. And Jeff shares with us his story today of how he got into the business of real estate, how he got into the allocator business, and talks about that industry in some considerable detail. So you're going to find it really, really interesting. If you have not already done so, please go to GowerCrowd.com and subscribe to my newsletter. It comes out once a week, and it covers everything you really need to know about investing in real estate, both as a sponsor, but also as an investor. This year, I'm starting to share some of the deeper experiences that I've had in this industry as a way of sharing the lessons that I've learned from those experiences over the last, I don't even like to admit it, 30 plus years is as far as I'm going to go with that, but 30, almost 40 years in this industry, especially as we go into a new economy, a new administration. It's going to be a very interesting time ahead. All that, GowerCrowd.com, just hit the subscribe button. But right now, let's meet Jeff Greenberg of Synergetic Investment Group. Here he is. Jeff, how nice to meet you. I see you all the time on LinkedIn, so it's a real pleasure to meet you in person and put a real face to the name. So let's start off with a simple question, very high level. What do you do for a living?
What do I do for a living? I have two equity funds where we invest in real estate and other alternative investments. I help investors get into quality deals.
And how do you do that?
How do we do that? We do a lot of interviewing of quality sponsors, getting to know them, and then when they have opportunities, we'll look at those opportunities and decide whether or not it's an investment that we want to bring our investors into. And I invest alongside of my investors. In fact, that was one of the main reasons I started up the funds. Is I had my own money that I needed to invest, and I figured, well, I'm going to bring other people along with me, and I'm going to invest alongside of them with my different funds.
So what's your background? I mean, I looked at LinkedIn. It goes back 17 years on LinkedIn.
Mm-hmm.
I know that you are a little bit older than 17 plus, I'm assuming high school graduation age. I don't mean to be rude or anything. So what's your background? What is your story, your personal story? Tell me, how did you...
prior to real estate or the beginning?
Yeah, I mean, doing with the Synergetic.
Well,
like you've been around.
Synergetic actually started in about 2010 when I started getting into commercial real estate. And I started out trying to do short sales back in 2007, 2008, which wasn't working out real well. It didn't seem the banks knew what to do with any of either the REOs, the foreclosures, or what to do. Things were falling too fast back then. And that's when I found out about commercial real estate and that I could raise money with other people and buy larger properties. And that's when I started to look at larger facilities. I mean, the first property I ever bought other than my personal residence was a 20-unit property. And then I went upward from there.
What were you doing before that then?
I was in IT. I used to work for a international company, and I was part of the network of guys that were keeping the business running. We worked the infrastructure, the hardware, kept the businesses running.
So why did you leave that?
Why did I leave that? Well, that wasn't going to take care of my retirement. Even though I was putting money away, I was going through a divorce. And when I looked at her getting the house and me getting the retirement, felt there just wasn't enough there. So for 8 years while I was still working, I was doing the commercial real estate. So I didn't quit my job for about 8 years while I was working full time, but I wasn't going to be able to retire with much. And so that's why I started looking for the real estate.
So why real estate though? Why not just continue in the IT business? Nice, steady, steady road. I mean, IT is constantly evolving. Why not continue with a job with a nice IT company?
That wasn't going to get me much of a retirement. I mean, even staying on that route. And once I started looking at the real estate, I lost interest in the IT stuff. It was real difficult to concentrate on IT stuff when all I wanted to do was to learn more about commercial real estate. Yeah, the IT is a job. I was working for somebody else, as they say. I'm making somebody else wealthy. I wasn't putting enough away for myself. I started to get another stream of income, and it was nice to be able to tell my boss when I was ready to go.
And so what were the type you can cast your mind back to 2010 and your entree into the world of commercial real estate? What were the biggest challenges that you faced?
Well, the first deal we bought, we needed to raise $350,000, and we thought, oh my God, that was huge. We thought that was crazy. How were we going to do that? So that was a huge challenge. Well, we were very fortunate on getting the debt side of it, where there was a bank that had the owners of this property actually was the developer. They built it in 2007 and they couldn't sell it. So here we were in 2010. They were lousy owners. The bank wanted to get them out of there. Very small bank in South Texas. And we thought, oh, we were going to have difficulty getting a loan. We heard all these horror stories about getting a loan. And this bank loved us because we wanted to be there, and he wanted these developers out. We never filled out an application. We gave them our resume as far as what we had been studying. We gave our personal financials, and we had the loan. We never even filled out a loan
They're
application.
called facilitating loans. So when I worked at East West Bank, I actually sold probably around a little in excess of $1 billion of this exact kind of asset you're talking about across every single asset class. And the regulators allow for what's called a facilitating loan. And that means that whoever's buying a troubled asset from the bank qualifies for a loan for that asset on two conditions. They have a heartbeat and they can sign. Basically, I don't mean to be too cynical.
No, but they wanted us in there so much so that the regulators, as you say, wanted them to cut down the leverage. And they came back to us and said, oh, you need to put more down. And we said, no, we can't. It just doesn't work. So the bank went out and got a second from the seller. They did all the paperwork and gave it to the seller and said, here, you fill this out and you're going to carry a second. And the bank did this for us, which is unheard of.
It is interesting.
Yeah. And so they carried a second for us so we wouldn't have to bring in more down.
So spin forwards now 15 years. And so you have seen the economy, the real estate economy, going up and up and up and up and up since you started. And the last couple of years, it's not been doing that. But let's talk about the asset classes you focus on. So what kind of real estate do you focus on and why?
I will tell you the asset classes that I did focus on, but that's not what I'm focusing on now. So if that's what you're asking, we were doing mostly C and B properties, multifamily. I also had 3 different student housing properties, starting from those were at least B. They were B properties, B plus properties, mostly on my student housing. The multifamily ones were pretty much C that we were pushing to B. The typical scenario, trying to increase.
Well, hang on, let me just jump in and clarify something. So you talked about buying a 20-unit property in 2010, and I'm asking more about the business that you have been in more recently, which has been to find sponsors. All right, you find sponsors and you bring it. So when you say investing in B and C, you're talking about finding sponsors who invest in B and Cs and then helping them to capitalize those projects. Is that correct?
That's what I'm doing now with my funds. We're investing in. We've got B and C, but we've also got some A properties, but not just multifamily. We've also have invested in mobile home parks. We've invested in a portfolio of short-term rentals, and we're currently investing in a portfolio it's a mergers and acquisitions fund of paving companies. So we've diversified out that way with the funds. And yes, we're raising money for quality sponsors.
Okay, so let's talk about that. What is that business? That's the allocator business, the capital allocator.
Yes.
So tell me a little about. That's what I'm interested in learning a bit more. How you do that. So what exactly, for somebody who isn't aware of it, what is a capital allocator? What is that role? Or what is that role that you take?
Yeah, that's basically, I find the opportunities through all different means. As far as the sponsors, I find those sponsors and I'm going to vet the sponsors. I'm going to see if I like the sponsors. And if it's a quality business model, I'll look at their opportunities. A lot of times I'll get people sending me opportunities and I say, I don't know you. I want to know the sponsor first and get to know them. And then I'll go on to look and see what they have to offer. If I find something that I really like, that I think is a quality deal, then I will offer it to my investors and I'll send it out to my investor list and bring in those that are interested.
So how do you vet a sponsor?
Well, right now I'm associated with a group of fund managers, and basically we are doing a lot of different things with our over 250 line checklist that we're vetting sponsors. So we go into their background. We want to go into their business. We want to know who's in the GP team, who's the asset manager, who's actually running the show. Do they have in-house property management, or do they do third-party property management?
Why does that matter?
We do a background.
Why does that matter? Why does that matter?
Well, there's pluses and minuses to both. There's pluses and minuses. Some people really like the third party. Some people like in-house. I like the in-house because you have quality control. You're probably not going to make a lot of money on a property management company, but you can control the quality, that whatever their workmanship is, or the way they treat people, your community. You have a lot more control over it. Other people like to get larger third-party management companies. And as long as you find a good company that is taking care of your communities and not trying to rip you off, you could go with third party. So I go either direction, but I just want to know. I want to know, which way they're going. Same with construction. There's people that have in-house construction, and there's advantages to that. You have a lot better control on the finances and the quality. But if you don't have enough work for them to do or whatever, you've got other issues. So it's just, we need to know about it, and we want to learn about the business. We want to know what's going on in their business.
So how do you make money, Jeff, in these scenarios?
Yeah, typically what we do with the funds is, because we're bringing in a large check to the sponsor, we renegotiate the terms. So we may get a higher pref, we may get a better split, and that way we're able to give our investors equal to or better than what they would be able to do if they went right in directly into the deal. And a lot of times these deals have larger minimums that we can help investors get into deals with a smaller minimum because they're going through our funds. But yeah, so we get our cut basically on that delta on what we negotiated in terms.
All right, so let's actually talk about some real numbers, if you don't mind. So,
Mm-hmm.
for example, what would be you talk about writing bigger checks? So, what does that mean? Kind of give me an example of, like a real case study.
Well, typically with the group that I'm working with, and it is a group of fund managers, we may come in with a couple $1 million. We've done some $2 million deals. We've done $1 million deals. It may be a smaller deal. We're only coming in with 500,000, but it
Okay.
depends. And the larger check that we could come in, typically the better economics that we can get.
And what do those economics look like? Give me an example of the.
Well, say that the sponsor is going to give a normal investor, say a 7 pref or maybe an 8 pref, but they'll give us a 10 pref. Uh, as far as on the splits, they may be going a 60-40 on the split, where maybe they'll do a 70-30 for us. And then maybe after a certain hurdle, after they get to say a 15%, they're going to do a 50-50 to a normal investor. And a lot of times they'll drop that off, that we don't get that at all. There's no cap on what we can get. So all different ways, to skin that one.
And so typically what you do is you form an entity, do you? And your investors invest in the entity that you set up, and your entity is the investor with the sponsor. Is that typically how you structure it?
Well, I have done it that way, but we don't set up a separate entity on each one. We have a fund that is customizable. So somebody comes in, they can pick and choose whatever offering we bring into the fund. So if a new offering comes in, I don't have to set up a new entity. I just put it up on the website and I'm able to offer it within the fund. So an investor comes in and says, okay, I want to invest in that deal. What they actually do is invest in the fund, and then they allocate that money to that deal. And they could be in many deals within the fund, and at the end of the year, they'll get 1K1. So they could be in multiple deals, but it's all under the umbrella of the single fund.
Okay. And so you have just one set of documents that you ever create for all of your investors. Is that right?
We have the one fund document, and then what we do is we create a document called a deal disclosure. And that deal disclosure discusses the specifics of that particular deal. So it will tell you what the projected returns are, how the splits are, and anything particular or any particular risks to that particular deal. It spells it out rather than the generic and general statements that we have through the fund. And so that way we can specify exactly this particular deal.
And so how does that fund then invest with the sponsor? Does that the fund makes the investment as an LP with the sponsor?
That's
How
correct.
does that work actually?
That's basically it. The fund will sign up onto the sponsor's portal, and in the fund name, we'll make the investment and wire the money. And basically, we are an LP, and the sponsor never knows who my investors are. They only know us as the fund. So we keep our community together. And when there's updates, we forward the updates to our investors, keep them informed on what's going on with the opportunity.
And the updates come directly from the sponsor, do they?
Yes, they come from the sponsor.
So when the fund gets the update, you just forward those to your.
Well, we may repackage it, may add something to it, because we're also getting other pieces of information beyond the normal updates. But we'll keep the investors informed, and like I said, we may repackage it some, add some information or whatever.
And right. And so now you're so in a situation where you talked about in some cases you got sponsors that might have a really big minimum. Say they've got $1 million minimum, but you're able to bring $25,000 investments or even smaller into that through your fund structure.
Correct.
But in a situation where you've got a sponsor who has, let's say they've got a $25,000 minimum, what is what stops them? Or, let's put it this way: what value do you bring
Mhm.
that adds value to an investor that means that they go direct? If you're taking the delta, economically, there's no benefit
Mhm.
investing through your fund or directly with the sponsor. So why would an investor invest with you and not go straight to the sponsor?
Well, it's interesting you asked that because I had a conversation actually today with a lady who couldn't find any deals. How do I find deals? How do I find sponsors? And I'm sitting here telling her you go to conferences, you can go to all kinds of things to try to find people. But because of the circles that I go in, I'm finding those sponsors. Most of them I've known over years, and I'm able to meet them and get into the deals. So first of all, there's finding the deals. Okay, they go around me, they're not going to be fine. Okay, they can get into that deal, but where are they going to find the next deal? So that's part of it. The other part of it is I'm looking at the financials as they come in, and I'm looking at those and I'm looking out for the investors. So they have me looking out for the investors. But the main thing, the big one, is due diligence. No investor does the kind of due diligence that we do. Typically, with the group that I'm involved with, which is a group of fund managers, if we decide that we want to go and do the due diligence on a deal, we split up the due diligence. And like I said, we may have a 250 line due diligence sheet that we go through. We do background checks, we do hours of conversations with the sponsor. We dig into their life to find out what is going on with their business, what's going on with the market, what's going on with the particular deal. We dig into the PPM, read all the legal stuff, go into the loan documents. I don't know of too many investors that are going to really do that. So we're doing all these steps to protect the investors and to take as much risk out of it as we can. So that's what we're offering.
So it sounds like I'm just kind of intrigued because, as I said, the clients that we work with are usually huge institutional scale sponsors. So for a $500,000 investment, you said sometimes you do 500. It sounds like a lot of work for a sponsor who can go to an institution or to people that they know already. Why do they work with you
Well,
and your group, right? If it's a
right. I
million
mean,
dollars or half a million.
yeah, the 500,000 probably isn't as typical. It's more of a million investment minimum. I mean, there could be some 500. Well, the thing is if a sponsor could go to an institutional player, first of all, there's going to be a lot more scrutiny than what we do if they go to an institutional player. But the other thing is institutional players typically are going to put on a lot more rules.
Yeah, no,
They're going
I didn't mean institutional. What I meant was that the sponsor just goes to accredited investors directly. They're not going to get the same degree. It's a lot easier
oh
for
yeah,
them, right? And if you talk about $50,000 minimum, it's 20 people versus on $1 million investment. Maybe it's easier to just go and find 20 accredited investors. I'm just curious, what is the value
mm-hmm.
that you bring
No,
that they are willing to do all this extra
oh,
work and
absolutely.
yeah.
As a sponsor, a previous sponsor, I could tell you I would love to have had people come in, with $1 million or $2 million or $3 million, and I wouldn't have to go after those 50 people. That is a lot of extra work. Now, you're absolutely right that your individual sponsors would not be digging nearly as deep as we do. So that part of it they suffer through because that's how much they want us. Because for us to be able to give them a couple $1 million, that is I would have loved that. I would have loved that when I was
And
doing my syndications.
Jeff, so that was when you're talking about having had wanting to raise 350,000. So obviously, somebody walking through the door saying, "Here, we've got pockets 3 times as deep of that." Of course, that's very interesting. But the deals that I work on typically are, the $20 million raise. So $1 million is neither here nor there. They're not going to spend the time.
Right.
So typically, what kind of scale of sponsor are you are most receptive to you and your group, do you think?
Well, first of all, I just want to say that the group has been going for a little over a year, and I believe last year we raised 10 million, so we're just getting started. So we're looking to get bigger.
This is Madfee and Bobby, right? We're talking. Yeah, Connected Investors. Oh, yeah, they're fabulous. Yeah, I've been talking. I've seen you on some of their calls actually on Friday.
That's right. We had a discussion on one of the calls.
We did.
But the point is as we get larger and come up with larger amounts, then we will be able to get into some of those larger deals where we may take over a whole deal. Or right now we're taking portions of deals, but we're looking at higher and higher quality deals as we're able to get larger and larger. And we're seeing some fantastic sponsors and great deals.
Jeff, so do you invest in the deals that you bring to your investors?
I am investing alongside of my investors in every deal.
And typically, so if you raise, so you said inside the group, you might raise $1 million, but typically how much of that will you bring and what proportion of that will you invest typically?
It depends. It depends on the investment as far as how much I'm going to personally raise. It may be, a couple 100,000, maybe $500,000. I did a 2 million on one previous from just my investors. So it depends. And as far as how much I'm personally going to invest is going to depend on my liquidity. Liquidity goes up and down. I just yesterday received an LOI on my last property, and when I sell that, I'm going to be liquid again. That's so how much I invest alongside depends a lot on what's available to me at the time. But I try to get in there and be one of the larger investors.
And just curious to understand scale. So how much have you raised in total doing the allocator business? And how much in the last year?
The allocator business, I've raised probably about 6 or 7 million, somewhere around in there.
And the reason I asked last year, I'll tell you why I'm asking last year, but why and how much in the last 12 months or so? Like in 20
last 12 months, I only invested in one deal.
Why?
Why? Because I didn't see anything I wanted to bring to my investors. So I raised 100,000 last year.
Yeah.
I don't have to raise to survive. I only invest in deals that I feel are worthy of my investors. And last year I haven't done anything else. December I did a deal, a mobile home park, but that was December of 2023, and I did one deal in 24.
How have the deals you've been investing in fared over the last couple of years? There's been a lot of trouble in the market, hasn't there? How have they been doing?
Yeah, I have a couple of deals, the multifamily deals that have stopped distributions. I think there's a lot of people that are in that situation. I've got others that are doing fine. I had one that I was the only investor in, and it was an A property, and we had a cash call. But I'm the only investor in that particular deal. And I didn't bring anybody else in, but it's been a slow year. It's been a slow year.
Jeff, what lessons have you learned from these deals that have not gone as planned?
Well, first of all, I don't like bridge debt. I try to stay away from it as much as possible. And if we do go with bridge debt, I want to know exactly, what the terms are, and I have to be very comfortable with it. I would rather have fixed debt. That killed a lot of people. The other thing is insurance and property tax, you got to take a close look at what those, because those are going up like crazy, especially insurance, just nuts. But one of the things from my syndication days is having raising enough capital, having insufficient capital to carry you over when you hit some road bumps is critical. I mean, I had a property that we held through COVID, and we definitely had some road bumps, and not having enough cash was a real stress on the whole deal, but we pulled it out. So
again, when you say this was your investment with a sponsor, was it?
No, those were ones I ran. Those were deals I ran. I haven't done any deal with a sponsor full cycle yet. Okay. All of the deals that I'm in with sponsors that I'm invested in, those are still going. So I've had my own full cycle deals, but nothing with a sponsor yet.
So what are the biggest challenges you face as a capital allocator, Jeff?
Well, a lot of people are rightly concerned about what's been going on in real estate. A lot of people have gotten hurt, mainly from the increase in interest rates.
When you say concerned, in what way concerned?
Well,
when you say
there's properties that have been lost. There's properties that have gone back to the bank. And I personally know people that have given the properties back to the bank, and because they just couldn't pay the debt because of the interest rates. So, we can reduce risk as much as possible, but there's always risk. There's always risk, and we do the best that we can to reduce that risk and to mitigate that. Mm-hmm. And so there are people that listen on the news and they hear what's going on, and so a lot of people are concerned. So it is harder right now to raise capital because people are very concerned. And like I said, I invested in one deal last year, and it was a business. It wasn't real estate. It was a business.
What will get people? What do you think will get people off the fence?
Well,
so let me put it this way. You didn't say they were on the fence. You said they were concerned. What do you think will throw the switch on their concern going forwards? Do you think they will ever invest in real estate again? And if they do, what will motivate them to do that?
There people will come back to real estate. I mean, the returns, you can't beat the kind of returns that we're seeing in
unless you lose everything. Well, hang on a second.
Well,
you can talk about returns being fabulous and building wealth, but we're talking right now about people losing their entire investment. So what throws the switch to get people to realize, to invest again in real estate? How do you address that concern?
Well, first of all, I tell people to invest in smaller increments and don't throw all of their money into one deal. I also encourage people to diversify amongst different kind of assets, different asset classes, different regions. Do as much diversification as you can. And as a passive investor, you have an advantage that you could do that. As a deal sponsor, you don't want a deal sponsor that's diversified across all different asset types and classes and regions, because that's too much for them to be able to really control. So I do like specialized sponsors, but that gives the opportunity for investors to, protect their investment by spreading it out. And you could do that in smaller increments. You don't have to put everything in one deal.
Interesting. So you've talked about diversification and the way that you talk to your investors. How do you manage, or how do you stay compliant with securities regulations?
As far as which our fund is regulated by the SEC as well as FINRA, and so we have all the compliance issues that we have to go through.
Give me an example of that. What do you mean by regulated by FINRA?
Well, one of the things that we have to do, because it's a fund, we have to do what's called blue sky filings. We have to file with the state and let them know that we have.
Are you audited? You're not audited though, are you?
No, we're not audited.
Right.
We don't have to be audited. but we do have to let them know when we have somebody from their state invested in the fund.
Right. So what I meant was that basically you're not selling real estate, are you? You're selling securities.
Yes.
So how do you stay compliant in that world?
Well, it's the same thing as the syndication. When we do with the syndication, we're investing as an LP, and yes, we are selling a security, but we have our exemptions, and basically the same exemptions that you would use normally in real estate. The 506C rule on the Reg D. It's a Reg D 506C. That's from the SEC. There are some things with FINRA that we have to stay compliant with, where we're not a registered advisor. So there's certain things that we have to do because of that.
Like what, for example?
Okay, so when I do an offering, I offer something up on my fund. Okay, I'm not advising people about this investment. I'm presenting it. They have the last choice as far as whether or not they want to invest. It's not like a regular fund that they invest in everything that's brought into the fund. So they have the last choice of whether or not they want to invest. If you're in a regular blind pool fund where you're in the fund and you're in everything, that's a whole different story. But we don't do that, because then I would be considered a advisor, and that's not something that we want to do in order to stay compliant.
What would you say are the typical kinds of investors that you work with?
I have all kinds of different investors. I have doctors. I have lawyers. I have some entrepreneurs that have sold their businesses or something. So it's.
You've also got a brother-in-law. I read your website. You got a brother-in-law as well, don't you?
I got my brother-in-law who's a retired teacher. So, but it took me. It was probably about 10 years into it when he finally decided to invest with me, though. People talk about starting out with friends and family. I didn't start out with any friends and family, but my brother-in-law.
Where are all these investors from then? How have they come to you, and why do they?
All over the place. I did take a look, and a good majority of them are from California. So a lot of them are from events that I've gone to, that I've met them in person. I used to hold about 3 different meetups, and I would attend 3 or 4 others in the region. A lot of them are from boot camps that I've gone to, different conferences I've gone to. Some of them have been my coaching students that I've coached and decided to invest with me.
Jeff, what conferences do you like to go to?
I've gone to the best ever. I've gone to that one for like 7 years. I used to go a lot to different Rod Cleef's different boot camps and get new people just learning the business, realizing that being an active investor is not as easy as it looks, and they decide, I'll just be a passive investor, and so a lot of people come from that direction. I've also been on probably 50 different podcasts, and so I've gotten people contacting me from podcasts as well.
Fascinating. So how do you educate these investors about the risks and opportunities? Like, what's your process for doing that?
Well, when I present a deal, I'm going through.
Other than marrying their sister.
What's that?
Other than marrying their sister and waiting 10 years.
He married my sister. Yes.
Right. Yeah, he married your sister, right? Okay.
He married my sister.
Other than that, though, how do you educate investors about the risks and opportunities? Like, what's your process for that?
Well, typically, I have mailings that once somebody gets on my list, I go and I work on educating them, telling them about the business, telling them what I do. I encourage them to get onto a call with me to get an appointment in the calendar. And then we talk about the business. I want to see where they're coming from. A lot of people are totally newbies, like the lady I was talking to today, and others have some experience, but maybe they want to get into commercial real estate. Maybe they're doing residential. And so wherever they're coming from, I work with them and try to help them learn about the business. And typically I encourage them to read a couple of books that I refer out there. And, as well as I'm perfectly willing to talk to them.
Mm. And what have you found is the best way of finding new investors for Synergetic?
Well, for years, it was always, as I said, conferences, meetups, podcasts. But over the last year or so, I've been working more on the social media, as you know. And that's an area I haven't mastered yet. And I'm still working on that. I'm working through your program to try to master getting more people or meeting more people through social media.
Jeff, I'm telling you the LinkedIn thing, please stick with it. And I mean it. Yeah. You must just send me emails anytime you've got any questions. You joined the mastermind, right? You were on the mastermind.
Yes.
So I really mean that. I really, really want you to be
successful with that. I sent you an email to look over my my profile.
Will you send that again?
Okay.
I got a sudden flood of emails right as the holidays ended. Please actually, let me just. I'm not going to do it now because I'm recording a podcast, so I don't want to do it right now. If I wasn't recording, I'd have a look at it with you right now. In fact, when we finish, let's have a look at it together. Right, we'll do that right now in real time.
I was following your steps, and
good. So let's take a look. We'll do that together as soon as we finish recording now.
Sounds good.
All right. So right. So okay. So where do you think how do you think the allocator, I'm just calling it the allocator industry. I know it comes by other names, fund of funds and fund managers and various things, but let's just call it the allocator business. How is that industry changing or evolving, do you think?
Well, you know how it is when you buy a new car and all of a sudden you see the same car everywhere. Once I got into the business of raising capital and allocation, all of a sudden it seems that that's what everybody's trying to do. My big concern about the industry is people getting into it that never have done operations and don't know as much about the business itself. I wouldn't have changed a thing on the direction I came to get into this business, because now I know what it feels like to be the syndicator, to be the operator, to be dealing with investors on the other side. And it helps me out, relate to investors going in, and also to understand a lot of the questions I need to ask of the sponsors to understand what they're going through. And it helps me just be a lot more able to help out my investors, rather than somebody that just says, oh, okay, I'm going to be an allocator, and they may not know anything about the business.
Okay, I'm actually going to change up one of my last questions, because you've actually preemptively answered one of them. I got 5 rapid fire questions just to sign off as we wrap up, and then we'll do your LinkedIn thing. Okay, so here they are, and I just added one. Not added, but I substituted one. I'll tell you which one. So 5 rapid fire questions that I shall ask all of my guests on this brand new series. Thank you so much for joining me. It's a real pleasure to meet you kind of properly and to get to know you properly. But what, Jeff, has been the hardest lesson that you have learned in real estate?
The hardest lesson in real estate, operations. The hardest lesson is not sufficiently capitalizing on a deal, trying to get away with not raising as much, because you're stretched in between trying to get the best returns for your investors. Therefore, you don't want to overraise. But then if you don't overraise, then all of a sudden you find yourself short when you've got capital expenses that weren't planned. So insufficiently raising on a deal as an operator is a horrible thing to go through.
Second rapid fire question, which was
That
one that
wasn't
I'm
very
not going
rapid,
to. What's that?
that wasn't very rapid, but my answer wasn't rapid.
Oh no, it's perfect. It's absolutely talk as long as you want. There was what's been the most effective way you found of building your investor network? We've already answered that. So instead, let me ask you this: what has been the big? What are the big? So you've talked about this suddenly seeing all these other allocators. Now you got into the business. What are the biggest mistakes you see them doing
Well,
or
one
making?
of the big mistakes is insufficient due diligence. That I see a lot of them, especially the ones that do not have a background in acquisitions and operations of commercial real estate. They go and they'll look at what the sponsor offers and says, "Oh, okay, this is great. Wow, I'm going to raise money on it. You know, I look at your numbers, great." And I do not see a lot of them doing sufficient due diligence, and it makes me nervous.
So let me kind of paraphrase that. What I think you just said is that they are motivated by the delta before anything else. Is that what you think is
Well,
going on?
I'm sure their motivation is they want to do well for their investors. Yes, they want to make money. But I don't think they may be well-meaning, but a lot of them don't have the knowledge to really be able to dig in and do appropriate due diligence. And that makes me nervous because if things go wrong, it makes the whole industry look bad. So it makes us all look bad, even if they're well-meaning, if they don't really know the business well enough.
So what makes for a successful capital allocator, particularly today?
Well, for me, I like the idea that I went through the trenches, that I've gone through and run the businesses. Now, I did multifamily and student housing. I haven't personally done self-storage and mobile home parks, but I associate with others that have done that, and they bring in that expertise that I might be lacking on a particular business or on a particular deal. And that's why I like the collaboration with others, that we can help each other with any knowledge gaps. But not everybody does that.
So if you were to go back in time, what advice would you give yourself in say 2000? You said you entered the business 2010,
Yeah.
knowing what you know now about the world and
I
the
would
world
have
allocating, etc. What advice would you give yourself?
I probably would have gone bigger faster, would be one thing. I would have gotten a lot farther, a lot faster. But just realizing that, just adding more zeros onto the deals, doesn't make it any harder to do. But I guess the hard part is learning how to allocate, to raise the money, and to get investors. I probably would have started social media earlier, because you can reach larger numbers of people. But now I'm in the situation of learning the social media side of it.
It's all right. You got me on your side now, so you're okay. You're all good.
There we
Yeah, and I'm
go.
having so much fun with that. I really want you to lean on me as much as you need for that. Last question then. So what's the biggest misconception do you think that people have about the allocator business?
They think it's get rich quick, which it's not. A lot of
Why do they
times,
think it's get rich quick?
I don't know if they just want it to be get rich quick.
Is
I
that
don't know
because they're
why.
told that it's get rich quick though?
Yeah, probably. I mean, with the real estate business, a lot of times you get the gurus are telling you that. I mean, the gurus are telling you, in 6 months you'll probably be able to quit your job, as a operator. And that's typically not the case, especially when you're giving your investors a preferred return. Usually any cash flow is going to them. As the operator, as the syndicator, typically you're not seeing a lot of money coming in. You may get an asset management fee, which maybe keeps the lights on, but you're not getting rich off of that. So
And
I
what
think
misconceptions do you think people have about the allocator business?
thinking that, oh, the allocator business, thinking that, hey, if I have a great deal, everybody's going to be jumping in. I'm going to be raising millions of dollars. And most of the time, those are the people that will come back with empty pockets because they think, oh, I got this fantastic deal, this great sponsor. I'm just going to show it to a bunch of my friends, family and friends, and they're just going to jump in. And most of the time they come back empty-handed. That's not the case. It's a slow grind, getting investors and making them happy and having them tell their friends and going upward from them.
Jeff Greenberg. I'm not sure what your title is. President, CEO, CFO, CMO.
All of them.
Anyway, of Synergetic Investment Group, founder, undoubtedly, Synergetic Investment Group. What an enormous place. It's such a pleasure to meet you and get to know you a bit better today. Thanks so much for joining me today.
Well, thank you so much, Adam. This was a lot of fun.
All right, that was Jeff Greenberg, CEO of Synergetic Investment Group. What an interesting fellow. I'm so grateful, Jeff, that you joined me today. And also thanks for joining that LinkedIn training. I do mean it. If you've got any questions, do email me. I'm glad that we had a chance to go and take a look at your profile, add some extra layers to that. I am here for you. Really mean that. And for anybody else that was in that mastermind, just let me know if you need any guidance, help, or suggestions or feedback. I'm always happy to provide it. And thank you to dear viewers for joining us today. If you've not signed up to my newsletter, please do so. Go to gowercrowd.com/subscribe or just hit the subscribe button there on the website. If you want to know more about Jeff, you will find him in the podcast page. I'll include links to his website and a little bit more information there. You can watch the video, you can listen to it there on the podcast page. Either way, thank you for joining me. Jeff, thank you. And thank you, dear viewer. It's been a real pleasure. If you're listening to this right now, it's probably just enough time for me to say Happy New Year 2025. But if it's months and months later, disregard that. But either way, that's all I've got for you this week. And until next time, this is Adam Gower signing off.